The following is a presentation of TFNN.
Welcome, everybody, to the Options Hour. My name is Don Kaufman, host of the Options Hour. And again, thank you guys very much for joining me. You guys know every Tuesday at 12 noon Eastern Standard Time, join me for the Options Hour. Of course, it's a call-in show. You can be called, talk about anything stocks, options, futures related. Give me a call, 877-927-6648. The lines are wide open. And, hey, we appreciate it if you give us a call. Talk about some of your option trades, questions about option trades, really anything options related. And in that regard, of course, if you've got a stock you're thinking about building an options trade, give us a call, whether it's bullish, bearish, flat, a neutral trade. I'll definitely talk you guys through it. And, of course, I do talk a lot about defined risk option trading. I talk a lot about probability on this show, talk a little bit about volatility on here, and the markets, of course, in general. But again, the lines are wide open. Give us a call, 877-927-6648. I'm also watching the Tiger Den. So if you guys are in the TFNN chat room here, feel free to chat in different questions. I will kind of read them aloud here and hopefully get you guys an answer to those. So give you a quick rundown of the markets. We'll take a couple calls. We'll talk about markets again in general here. But all right. Let's actually go through a quick update here of the marketplace. So E-mini S&P 500 futures up a point on the day, only up 75 cents. This is what we call massively unchanged on the day. Markets have actually had a decent range, though, on the futures throughout the trading day. NASDAQ futures up 275, Dow futures down 34. VIX is literally flat on the day, down a whopping 3 cents. And other than that, big mover on the day, of course, is bonds. And, gold has actually been a little bit, all over the place. Again, fairly wide range on gold today. Gold is actually trading, the futures are trading up to $12.50, $13 right now on gold. When you see a move like this in a market, when I say when you see a move like this, we've had some pretty volatile days as of recently. And when you look at the futures, and they're pretty much unchanged on a day after, how many weeks of volatility, you got to look at the markets, and the markets get tired. People get tired. The markets get tired. But ultimately, you're seeing quite the move right now, of course, in the bond markets. That's something, of course, to keep an eye on in these bond markets as capital typically comes out of the bond market, of course. I've talked about in previous weeks being short bonds and so forth. But as markets, again, are kind of cyclical here, meaning that when capital comes out of the bonds, it could come flushing into the S&P 500. So it's something to keep an eye on. We've seen a couple of late-day rallies here as it is, and I would definitely keep my eyes open for that. Again, the VIX is completely flat on the day. The volatility really isn't dictating anything. The markets right now, S&Ps, are really not indicating anything. So ultimately, what have we got? We've got a bond market on the move, and gold just rallying kind of slightly on the day after being off overnight. Anyway, with that, let's jump to a few callers here. And again, if you guys are thinking about it, give me a call. Literally, lines are wide open, 877-927-6648. I'm going to jump to our first caller. Michael in Toronto has got a question about the ThinkorSwim products. You there with us, Michael?
Yes. Hi. How are you today?
Good. How's it going?
Oh, okay. I'm a ThinkorSwim customer through TD Waterhouse here in Toronto.
Yeah.
And I got onto the ThinkorSwim platform by listening to your show.
Oh, excellent.
Yeah, actually, you recommended it, and based on your recommendation, I opened an account. And I want to thank you very much.
Oh, yeah, thank you.
Okay.
Thanks for being on there.
Another thing is, first question is this. I use TD Ameritrade's quote tracker trading platform.
Yep.
Okay. And been talking to TD Ameritrade in Baltimore, and they're slowly phasing out quote tracker.
That's my decision.
And I want to know, there's some rumors, just rumors, going around that they might integrate the quote tracker API into the ThinkorSwim platform. Is that true?
Well, you know what? So basically, I actually happen to work in what's called the active trader division. So anything like technology related, for clients like yourself. So we actually drive technology for ThinkorSwim. We drive technology for what's called Trade Architect. That's a joint venture kind of between ourselves and the general TD Ameritrade tech team. And, what we're trying to do is really, you're trying to accommodate everybody, but at the same time, you can only focus on so many different technology products, at one time. And ThinkorSwim it's a beast in terms of, resources. So, we are thinking about incorporating that in there. It's a rumor, though, at this point, but we're definitely...
Is it hard to do? Couldn't you add a tab through profit in the profit section?
Well,
couldn't you add a tab for Quote Tracker API?
Well, what's easier for us to do is to build it and just replicate it right in ThinkorSwim. So ultimately, the primary features of Quote Tracker, almost everything it has is already encompassed somewhere in ThinkorSwim. We'll just take that to the next level. So there'll be a build in the future that can encompass some of the aspects, that are really required so that we can eventually, sunset, the Quote Tracker and encompass all that technology in the ThinkorSwim. And that ultimately, we believe, it's a cleaner way to do it. Rather than have 15 different pieces of technology, literally with duct tape, stuck on into ThinkorSwim, we'd rather redesign it, make it cleaner, and of course, you want it to run as fast as possible. And technology from 10 years ago versus today, it's a different world, and we're on the absolute cutting edge on the ThinkorSwim side, where some of the other products from TD Ameritrade, they become a little bit antiquated, only because there's not a lot of design and development moving into those right now.
This is basically a very sophisticated Excel spreadsheet, isn't it?
Yeah, that's exactly. I mean, what Quote Tracker really is basically like an Excel spreadsheet. And so something interesting, and I don't know if you're on the screen show right now, is what we have right now that you could also look at is, so I'm looking at a quote screen on ThinkorSwim. You can export a quote screen into an Excel spreadsheet through what's called a DDE link. So it's a dynamic data link. So you can actually literally export live data into an Excel spreadsheet and tweak it any way you want. But then we took it a step further. We're like, why does somebody want to export data? If you are capable of writing any code, and there's a lot of code right now for ThinkorSwim that just exists on the web. So if you actually start searching on web and searching on Google for what's called ThinkScript, there's a lot of scripting done. And basically anything you can think of in terms of quote details, somebody has scripted, and all you have to do is script it and drop it into the program, and you're ready to roll. So when I say that, I mean the sky's the limit. You can run scans on ThinkorSwim. There are so many facets of this program, and I actually I've been with ThinkorSwim almost since day one. So you name an aspect, I can usually kind of talk you through it.
Okay. Next question is Brent crude oil on ICE. What is the ticker symbol under ThinkorSwim platform?
We don't have it.
Why?
They want to charge a fortune for that quote.
So you can't do the famous Brent WTI spreads.
So the honest truth is that particular exchange charges quite a bit for that one quote. And we have always had this notion, why does an exchange charge us heavily for the data?
Is it just ThinkorSwim they're punishing, or everybody?
No, it's pretty much everybody. But so most firms will actually make you pay the data fee. We don't do it that way. We punish that exchange by not routing them order flow, meaning that we'll say, listen, if you don't give us a quote for next to nothing, we won't have any clients. And we have the single largest options order flow in the entire retail industry, and our futures order flow is massive now too. So I will tell you this, we are working on that one right now. We're also working a lot in terms of European markets and having a lot of some of the European futures on there. That is all, the futures products is exploding right now. All of it will be on the platform.
Oh, I see. So you want to add like multiple exchanges, so you basically want to kind of be like interactive brokers.
You know what? It's
down
not,
the road, huh?
To be honest with you, we don't want to expand into every single market around the world. The liquidity isn't great in most parts of the world, but it'd be nice to have some of the European futures out there. The reality is for us to list markets, over in Singapore and Australia, there's no volume there. And it's not in a client's best interest to trade products that are illiquid. You're up in Canada, and there's not huge liquidity in Canada. Everybody wants to trade the U.S. markets, and I hate to call them the U.S. markets. The U.S. markets have become the world markets right now, and that's always going to be our primary focus. That being said, there's a lot of people that, hey, they want to trade DAX futures overnight. Yeah, we totally get it. They want to be able to trade some European bonds right now. Absolutely, we're looking into all of it.
Yeah, but the TD Waterhouse account execs told me that they are in the process of integrating TSX and TSX Venture stocks into the ThinkorSwim platform.
Yeah, for sure. We've got a lot of Canadian clients. Obviously, TD Ameritrade is owned by 45% ownership by Toronto Dominion. up there. So, yeah, no, it's a good time.
So you are in the process of integrating it, correct?
Yeah. Oh, yeah. We'll eventually offer all these products. And, again, there's slower integrations because when you look at, like, the scope of things, what are people really going to trade? I mean, and ultimately, Brent, crude is important to us. For sure. Yeah. So I'm going to have to jump, but...
okay, thank you very much.
Yeah, thank you. Thank you. So, all right. Great caller, more about technology. By the way, you know what? Those calls are totally fair game, meaning that if you guys want to call in and talk a little bit about ThinkorSwim technology, some of the TD Ameritrade stuff, by all means. But, hey, this is an options show. So if you guys want to talk about defined risk option trading, for the most part, give us a call. In fact, you want to talk about undefined risk option trading. That's always fun, too. So with that, give us a call at 877-927-6648. And I will be happy to answer your questions live and uncut on the show today. So today I'm coming to you guys live from Las Vegas. I didn't mention that. If I seem a little slow today, it's because I'm in Vegas and it's 9 o'clock in the morning. So as you might know, Vegas has that effect on many, many people. So I'm over here in the MGM Grand. We happen to have a huge show with one of our education partners. Of course, InvestTools from TD Ameritrade is here kind of presenting a show, and it's pretty exciting. We've got a number of big motivational speakers. We've got Bill Clinton actually speaking at lunch today. That should be interesting, and I'll be doing a session this afternoon. Tom Sosnoff's doing a session today. It's good times. Anyway, with that, we got the lines wide open for you guys. The number is 877-927-6648. I'm going to talk a little bit about the markets in general. Feel free to also chat in questions to the Tiger Den. But literally anything you guys got, fair game, give us a call today. So with the markets a little bit flat, as I say, markets get tired. People get tired. Markets get tired. It's been a wild couple of weeks. And you look at the VIX. The VIX has been sustaining like a 40 vol. That's something to think about. So we've seen a sustained high level in the VIX for a considerable amount of time. And a day like today is an interesting day when you see the VIX at 38, and the markets are literally really not moving right now. There's a lot of premium on the table, and that means there's a lot of juice to sell. And these opportunities don't arise all that often. If you look back, for instance, at the volatility index, I mean, you can go back a considerable amount. How often do you get a sustained volatility at this particular level? And I'm actually going to go onto a chart. If you guys are on the screen show, I'm going to go back in time here. Just want to kind of point something out. Let's go back 10 years, for instance, on our screen show. And you'll see that the volatility being sustained even over 30, okay, for a significant period of time is not a common theme. And obviously back in 2008, we had some pretty substantial volatility. But as I scroll back in time here, even back 10 years, it is very infrequent that you see any sustained period of time, much less weeks of time, that the volatility is sustained over 40. And the reason I mention this, and of course, I'm all the way back right now to 2003, where we saw the volatility, over 40 for a brief amount of time. 2001, 2002 during the big Nasdaq sell-off as well. But literally, again, you see volatility up this high. So what does that really mean for you? So you're a guy sitting at home. You're considering option trades. What does the volatility being over 40 or over even 35 have to do with me? And ultimately, what it entails is volatility kind of works like an elastic band or a rubber band. If you look at the average volatility, all right, and we'll talk about like 25-year volatility, you look at the average, for instance, the VIX, and the VIX is the S&P 500 Volatility Index. That average is somewhere in the neighborhood of between 20 and 25. Now, in more recent years, that average is even slightly lower. If you look back in, for instance, 2005, 2006, volatility was all the way down in the 10 or 12 level. And right now, volatility, again, is sitting at 40. So the volatility, if you look back about 10 years, the average is closer to 17. Okay, so the mean, the average is about 17 in volatility. And again, you're sitting there and you're like, oh, well, that's great. So the VIX's average is 17. Right now it's sitting at 38. There's opportunities there because ultimately what an increased level of volatility entails for option traders is the ability to sell options in ultimately inflated premiums, assuming that volatility sooner or later okay, will contract. Again, volatility works a little bit like a rubber band. Right now, it's extended that rubber band all the way up to 40. Sooner or later, it snaps back into alignment, okay, and you'll see the VIX over time will obviously migrate back down into that 20 or even 17 handle, which is obviously a range. So ultimately, as an option trader, what strategies do you look for? Well, there's a couple things. You ultimately want to look for strategies that get you short volatility. Now, short volatility can be a number of strategies. You could go out there and you could sell a vertical spread. All right, you can be directional with a vertical spread. You can make vertical spreads non-directional. The directional spread might be selling a put spread. If you sell a put spread, that makes you bullish. If you sell a call spread, that makes you bearish. If you sell a put spread and you sell a call spread simultaneously, it's an iron condor. It's a net neutral trade. So you can create any one of these strategies, but those are inherently short vol trades. Okay? And the difference with options is that when volatility is extremely low, when volatility is low, you have tendency to be selling options right on top of where the stock price is. So if you were to look at the spiders right now, and the spiders are trading at $117, okay, that's where they are right now. And if volatility was sitting at like 20%, okay, vol was at like 20%, you'd be selling options $3 or $4 out of the money. But volatility isn't at 20%. Volatility is almost 40%. So instead of selling an option $3 or $4 out of the money, now you're selling options that are $6, $7, even $8 out of the money. So what it does is it gives you more breathing room, meaning that, so if you're selling, if you're looking at the underlying and it's a 117 underlying, all right, so it's a 117 underlying, and normally you'd be selling options in a 20 VIX around 120. Now all of a sudden you're selling options way further out of the money. Again, it gives you more breathing room, but more breathing room, hey, it's a more volatile market. But when you see volatility start to collapse, and that is volatility reverting from 38 back down to 20, ultimately, okay, that sucks the premium out of these far out of the money options. And that's ultimately what selling option premium is about. So you can make money in option premium. When you sell option premium, you can make money as the option decays, but you can also make money when you're selling option premium. You can also make money as volatility contracts. So always, keep that in mind for those of you that are premium sellers. The other thing that you want to think about is in terms of strategies, yeah, you can use vertical spreads, and vertical spreads are defined risk trades, all right? But you can also utilize calendar spreads, okay? And calendar spreads, you got to remember, though, are long volatility. So you would have to ask yourself, would you want to get long volatility in a volatility index that's already extremely high? And the answer most of the time is, well, no. I don't want to buy volatility in a 40 vol. So those are your two primary strategies. When you think about option trading, when option trading comes down to it, how many strategies are there? Well, there's vertical spreads, and there's back ratios, and there's diagonals and double diagonals and collar synthetic combos, and, unbalanced 1-3-2 ratio butterflies, and there's deep and wide, 4-month, 4-strike, double diagonal, straddle, strangle swaps. And people are like, well, what the hell is he talking about? I have no idea. But no, in the end, there's really two primary strategies. You got vertical spreads and you got calendar spreads, all right? And in a high volatility situation, you're more apt, okay, to lean towards vertical spreads. And vertical spreads equals iron condors. And vertical spreads is butterflies, But in the end, they're all that same strategy. People go, oh, butterfly is completely different than a vertical spread. It's not. Butterfly is just two vertical spreads. Iron condors, ooh, it's a scary thing. Iron condors are just two vertical spreads put together. So, whatever strategy you got. People say diagonals. Well, diagonals is just a calendar spread mixed with a vertical spread. And again, it's all the same crap, just twisted different ways. So, again, lines are wide open here. And if you don't call, I'm just going to be talking to myself for the next hour. So, by all means, give us a call, 877-927-6648. I had somebody actually send me an email the other day, and he said, I don't call in. And I said, why don't you call in? He goes, I have plenty of questions, but I'd rather hear you go on these long tangents and rants. So, by the way, I really appreciated that email because I was cracking up about it. So, if you're not calling in because you want me to go on a rant about something, I understand, but it makes it more exciting for me when you actually have somebody to talk to when it's a call-in show. So, again, the number is 877-927-6648. I saw a question actually pop up here in the Tiger Den. Anyway, Don, SLV, bottom of the channel. So let's take a look at SLV over here. And if you have called in, if you haven't called in, I myself am not a big directional trader, meaning that I get on here once in a while and I say, hey, I'm bullish on this, hey, I'm bearish on this, and people ask me about channels and stuff. I'm not a market technician at all. I'm definitely more of a tape reader, and tape reading is a little bit more old school. And what ultimately tape reading entails is, looking at relationships, for instance, the futures versus the volatility, the futures versus what bonds are doing out there. I've got my eye on gold because gold has kind of been the talk of the town, and I've wanted to be short gold. And this question actually comes up about SLV, and I look at SLV, and obviously, SLV is the silver, it's the iShares silver. SLV got absolutely hammered in recent months and has rebounded quite a bit from what I call its hammering there. And I think the hammering was back in May. May and April, I was actually in a couple of positions here, and it's actually rebounded quite a bit. In my belief, these metals are well overdone here, and I would say that gold is much more overdone than necessarily silver. Silver already took quite the beating, but again, this thing has rallied all the way back from that low 32 level, all the way back into the 40 handle again. And, I look for opportunities to get short. I'm a big-time contrarian, so I'm not looking for it forming support over here. I'm actually looking at this as another kind of topping formation. Again, I'm not much of a market technician. You have to understand I'm a contrarian. What's more important to me is when you look at SLV is the kind of trade you're going to construct. So right or wrong about direction, the bottom line is when I look at SLV, if I'm going to construct a trade, the stock is sitting right now, or, the iShares Silver Trust is sitting right now at $39.78. I would look on here to sell like an out-of-the-money call spread. I might sell the 42.44 spread, and I'll just pull this one up. The 42.44 vertical spread over here is trading right now for about 53 cents. It's not a huge amount of premium, and there's not a huge amount of premium because obviously this position is being done, and quite frequently that is. So the 42.44 spread's trading for about 53 cents. It's got about $1.47 a risk, so the risk is substantial for the reward in the play. But ultimately, so this trade, what does it leave you with? Well, the trade leaves you in the neighborhood of I'm actually going to look at probability of expiring right now. The trade leaves you with about a 70% probability of success, a little higher than that, 75% probability of success. And that is, success is defined by making 1 penny or more. But you've got, almost $1.50 a risk in this trade. If that's right for you, great. So that's one thing. But you've got to realize when you sell the 42.44 spread, that's defined risk. Can't lose more than $1.50. If the stock stays flat at $39.80, you're golden. If the stock goes up even $2, you're still all right. Even if the stock rallies $2, you're all right. If this thing sells off huge, again, you're great too. So obviously selling the 42.44 spread is a bearish trade, but it's bearish but kind of guarded, meaning that, hey, I'm bearish right now, but if I'm wrong, I can still make some money. The other thing you can obviously look at is still kind of a deviation of that particular trade is you can buy kind of an in-the-money spread, and I'm just ballparking this right now with you guys. So I could buy like a 41, let's say 38 spread. Oh, this is actually an interesting trade right here. If you buy the 41 puts for October, and you sell the 38 puts for October, it is done for a net debit. All right, this is a $3 wide put spread that you're purchasing for $1.50, and this trade is literally risk $1.50 to make $1.50. You got 38 days for this stock to sell off, but this is a little bit more aggressive. You need this stock to sell off, in which case this happens. What's interesting about this 41-38 spread is this is the equivalent of getting synthetically short stock. I mean, people go out there and they short silver. Why would you ever short the shares of the SLV? It doesn't make sense. You just go out there and, if you really got a conviction that you're bearish on this thing, just go out there and buy the put spread and sit tight. If you're right, great. You might make close to $1.50. If you're wrong, well, great. You might lose about $1.50. It is what it is. And, risk $1.50 to make $1.50. It's got up a 50-50 shot. But, when you start to look at this trade, it just makes sense because you don't have to use a stop order. If this thing blows up in your face and silver goes to 500, all right, it doesn't matter. You're going to lose $1.50. You're like, woo, thank you for losing $1.50. All right, so with that, again, I tendency to go off on some rants over here, but this is this is a better way to utilize products like SLV, like gold. And I've told people in recent weeks I'm short gold. I'm short gold, and I've definitely taken some heat. I've actually several times with my short position in gold. Gold sold off like $100 in one day. I covered some of the short spreads, and gold rallied back up. I sold it again, so I'm scalping in and out of some of the spreads out there. But I've actually laid my risk back out on the table. I'm happy right now being short gold. I'm comfortable with it. I'm also short bonds, and today, being short bonds today is actually paying off a little bit. So if you look at like TLT is down $1.16. TBT is up 47 cents. So TBT having an up day, even a blind squirrel can find a couple of nuts, but that's me. Anyway, with that, let's jump to a few callers. I got David in Maryland. I got a question about the spiders. Are you there with us, David?
Hey, Don, can you hear me?
Yeah, I can. Yeah, how you doing?
Hi. Yeah, I've been doing a little bit of a pairs trade, selling credit spreads on the SPY and selling credit spreads on the TLT. And I guess I wanted to ask you, does that make sense? And if so, how do you kind of line up the sizes? Is it just a beta weighting, or how do you kind of think about that?
So you know what? That's an interesting trade because I'm in a very, very similar position to that. So for the most part, being short, you're short out of the money call spreads in TLT.
Yeah, I'm short the 115 on TLT and the 126 on the SPY right now, but it's about break even. So. Yeah,
so I'm in a very, very similar position. So what you're actually talking about, and I'll kind of explain this for everybody listening, is you short TLT. Obviously, being short those bonds could be a smart play right now. I'm in a very similar position. But you're turning around then and hedging yourself by, also shorting, for instance, spiders.
Yes.
So you're kind of utilizing the spiders as a little bit of a hedge against the short position in TLT. And I've got almost the same thing on, and I'm short bonds, but I'm actually short just a little bit of NASDAQ. And that's the whole thing is how do you pair up bonds versus spiders or bonds versus NASDAQ? The thing is, I wouldn't try to beta weight and hedge one for one. If you want to be short bonds, you got to take some risk to get short those bonds. But then you turn around and do a couple of contracts, for instance, short spiders. And it's an interesting trade because typically if the bonds are selling off, the spiders are rallying. Today is interesting because the bonds are selling off and the markets are not rallying. To me, I would actually expect a late-day rally here only because the bonds are down that considerable amount. You got gold up today. It's we're kind of meandering and we're kind of directionalist right now. It's an interesting market because the relationships today, as I look at them, are a little bit screwed up throughout the day. And as you can tell, look, the market's flat, bonds are off, and gold is up. So basically, all the relationships that you normally see are kind of broken. So what you really have to start to discern is how much of that short spider position you really want on. If you don't have conviction that the spiders aren't going to sell off, then you kind of want to curb that back a little bit. And you can kind of look at the spiders and you can look at TLT. What's really, really unusual right now is the high volatility in the TLT. You don't typically see volatility this high. So volatility in the TLT is at 26, 27%. Then you got volatility in the spiders about 38%. So you're getting a little bit more bang for your buck in the spiders. What's also interesting is the TLT is trading dollar-wise for almost the same amount as the spiders. So with the volatility, there's similar volatility. The volatility in TLT isn't quite as high, and they're trading for almost the same dollar amount. You don't really even have to beta weight all that much. Does that make sense? So if you have, for instance, 10 contracts short position in TLT, for instance, about in the neighborhood of 8 contracts would work in the spiders as a pretty much a one-to-one offset. But the problem is, sometimes the relationship gets blown up like it is today. So that'd be a one-to-one. There's like 10 contracts in TLT would be equivalent to about 8 contracts over in spiders, with the small volatility differential. But the reality is, do you really want to do 8 contracts? Do you want to try to neutralize the whole thing, or you basically want to go out there and neutralize a portion? And that's kind of what you have to be able to discern.
Okay. But one other quick question for you, if you don't mind.
Yeah, fire.
On the TOS platform, is there any way to get like a daily standard deviation move? I heard Dan Sheridan talking about kind of
it's on there. It's the market. Yeah, it's called Market Maker Move. So if I'm looking at my screen right now, in the trade tab, in the upper right-hand corner of the trade tab, it says MMM. What the MMM is, that's the Market Maker Move. That's a one standard deviation, one-day move. It's exactly what it's designed for. So in TLT, it's like a 90-cent move is one standard deviation. That's 68%, and that's based on a kind of a blended implied volatility. So that's about as accurate as you're going to get. And that's,
do you kind of keep an eye on? Do you personally keep an eye on that to see how that's moving?
You know what? So I kind of keep an eye on it, but when I really keep an eye on it is when something's going to release earnings is when it gets interesting.
Okay.
The market maker move is great, but you know what? When TLT's, in the bonds, their volatility is rather consistent.
Yes.
You kind of get a feel like, all right, we're only going to move X amount today. The spiders and so forth. Spiders are pretty consistent. Their market maker move is also, you see, by the way, the market maker move in the spiders is about 86 cents, and TLT, interestingly enough, is almost the same. And that's just indicating because the volatilities are similar. It's a similar dollar-wise stock, too.
Okay.
Yeah.
Alrighty.
Yeah. Good stuff.
Thank you very much.
Right. Thanks for getting a call, David.
All right.
So with that, we got plenty of time, plenty of lines open. Give us a call, 877-927-6648. Fire any questions you guys have away, whether it's stocks, options, futures, commodities. Commodities have been the talk of the town lately. I've never had so many calls about the silver, oil, gold. A lot of people calling about bonds. But bonds have become a commoditized product. How high can bonds really go? I mean, you look at the 10-year. The 10-year was down to 1.9%. Ooh, that's exciting. I want to tie up my capital for long periods of time and make absolutely nothing on it. I saw safe sales. Okay, I don't know if you guys see this, but an actual safe like you would put in your house, like a gun safe. Sales of safes in the last, that's a hard one to say. Sales of safes have actually gone up considerably, in fact, skyrocketing in the last 6 weeks since the market sold off, because apparently people feel their mattress might be better than the 10-year note. And, hey, I'm right there with you. That's why I'm short bonds. Interesting, huh? Maybe I should get short bonds, long safes. Is that a good trade? Anyway, with that, I'm going to jump to the next caller. Jeff in Seattle has got a question about an options portfolio. You there, Jeff?
Yes. Hi, Don.
Yeah, how's it going?
So good. So following along kind of what you've been talking about a little bit here on building an options portfolio. Well, in early August, that we had quite a level shift, so I had quite a bit of credit spreads. And we've completely, shifted down to a different level, and most of those credit spreads are underwater.
Yep.
So I just kind of want to talk a little bit about, moving into October. I have a lot of credit spreads. This time I put more iron condors, so I'm kind of more neutral in both directions in the channel that we've been in.
Okay.
But we could still easily shift back up a level or shift down a level, and I could be negative for the month again.
All right.
What's the best way to diversify and to avoid this from happening to me month after month?
So there's something I've talked about for years in front of groups I speak in front of, and it's what I call, once you get comfortable with options and options trading and strategies, people are very much one-dimensional. It's the curse of what I call the curse of dimensionality. And what I mean by the curse of dimensionality is that a lot of people look at the market and they're like, it is September, I must trade September. And they, allocate all these September option positions, and then when September comes close to expiration, they close those out. And only towards expiration of September are you thinking about allocating to October. And then all of a sudden you've got all these October positions on. And what that does is it doesn't just lock you into one standard deviation. When you're in one expiration cycle, it locks a huge amount of your capital up, okay? And if we get a drastic shift outside the norm, which is just, outside of a one standard deviation move, and we've had some 2 standard deviations, even 3 standard deviation moves lately, when you get those, they absolutely rip your inventory apart. So if you look at your capital, let's say that you have, I'll make this easier, let's say you have $30,000 that you want to allocate into some options trading. You look at your capital in 3 equal parts. Okay, $10,000 allocated to September, $10,000 allocated to October. All right, and the last 10,000, you either have a number of calendar spreads that are actually allocating you out, for instance, right now, October, December, October, November, or you're keeping some powder pretty much in the barrel out there waiting to fire again into some higher volatility. One of the areas that people are good at is they finally learn to find trades, and you start to build trades and scatter your inventory, for instance, in 1 month. But what's harder to do is to start to scatter that inventory into multiple months simultaneously. So right now, I have almost every September position off. I don't carry any short options into expiration because I've literally got a talk later today in front of, a couple of hundred people, and we're going to talk specifically about options expiration, which, of course, this is expiration week, and not holding positions to the last minute. So I already have all my October inventory allocated, and to be honest, I'm looking right now to start allocating into November. I've already got some November trades rolling, but my allocation now needs to shift into November, and ultimately that's to cause a little bit of protection. So as the market moves, I'm allocating efficiently into multiple months. Because, again, let's say that we shifted large in the next week. What are you going to do with your October inventory? Well, there's not a lot you can do. You've already allocated your capital. And you're going to look to fix things. One of the best ways to fix a portfolio is to allocate a new trade into the next month. So in a period of high volatility like you just had in the last 6 weeks, you got this big, drastic move, and it was killing the trades that you had on. One of the only ways to move forward is to start to allocate new, fresh capital in the high volatility. I mean, because if you think about it, that's one of the best times to be allocating capital, and that's one of the hardest things to teach is to efficiently allocate capital even in the face of adversity. And you've got to, you've always got to strategically think with an under-allocation kind of in mind, meaning that in the back of your mind, you always got to be thinking, well, volatility right now is at 30%, but it could go to 45%. And you got to keep, obviously, some capital aside for that. And that's kind of the 2-minute, synopsis of that. You understand that's a long talk when we talk about capital allocation. Yeah. But did that kind of ring true a little bit, or you starting to allocate to multiple months?
Well, yeah, that's pretty true. I'm pretty much done with October. You were talking about taking advantage of this high rate of the VIX being high right now and lots of premium. So, but you're done with October pretty much then, huh? You're moving on to a lot of the November option trades aren't out yet.
So in the spiders and some of the major indexes, they are. But when you look at, if you have an underlying that doesn't have any November options right now, next week it will. I mean, so the Septembers are off the board, and on come the October becomes the front month, and there's always front and back months, and November's will be there. So when we're in October, I always say this, when we're in that month, I'm typically not allocating for that month. I'm usually already allocated. So, right now, hey, if I'm going to put anything else on for October, it needs to be done right now. Because I'm already starting to shift my allocations out to November. And it's not a half bad time to do that. You got to think, November options, for instance, in the spiders are sitting at a 37% volatility. It's a pretty good opportunity. Now, it's not to say could volatility spike back up to 48, even 50%. Yeah, but we've been sustaining this almost 40 level in vol in the S&P 500. They don't pay those kind of premiums very often. It just gives you the ability to sell crap way out of the money, and hopefully volatility comes collapsing back down. And, you can also look at putting some directional bias in this. You're a little bullish, you're a little bearish. Put some directional flair into your positions. It's it's a good thing.
Yeah. One last thing about getting out of trades, like these Septembers. I've gotten out of most of them, but I've got one or two that for the last 10 days, we haven't had a lot of up move in their put credit spreads, and you just think, well, I'll wait for a little uptick and then I'll get out of it. But, it didn't come in the last 10 days.
Exactly.
So then you're stuck struggling getting out of these last loser credit spreads. What's your advice? You said 4 to 10 days.
So I always say that, and I'll tell you a couple just quick stories in this regard. The single biggest loss that I've ever taken in my personal portfolio is they've always been dealing around expirations. And it's happened more than once. I mean, some stupid short out-of-the-money option that had no chance in hell of being in the money ended up, I had one that ended up $40 deep in the money, and because it was an overnight, print and an overnight gap in the S&P 500. So it's little stuff like that can cost you a lot of money because come expiration, there's nothing you can do to defend yourself. So, we're sitting here, Tuesday of expiration week. Come Wednesday, Thursday, Friday, what are you going to do? If the market moves against you, you're a sitting duck at that point. I mean, everything you do in this business is to mitigate risk, all right? So it's about controlling risk. It's about controlling your positions. And literally, in the last, 3 days before expiration, you roll the dice, say, what the hell? We'll just, let things kind of go and let it roll. And that's where people blow themselves up. And it's because all of a sudden you take a strategic idea and a strategic position and you change it into a gamble at that point. and that's just not a place that you want to be. So I always say this: cover your crap, which is basically close out your positions about 4 to 10 days out from expiration, and that's. I've got a talk I've got to do in about an hour and a half in front of a few hundred people. That's exactly what it's about. It's about going out there and covering covering yourself. So,
okay, thanks, Don.
Yeah, thank you for calling in. Hopefully that helps out a little bit, and just think about strategically allocating there. So, all right, thank you very much for calling in, Jeff. So with that, we'll jump to the next caller in just a moment here. And again, we've got plenty of time left. You guys can give us a call, 877-927-6648. Futures now are up 4, NASDAQ futures up 11, and this doesn't surprise me. I mean, again, when I look at the markets kind of meandering the way they are here, I would expect to see just a little bit of a rally here towards the close, only because the bonds are off so much. So again, this is a cyclical market. Money comes out of bonds, typically in the S&P 500. You got gold up today, but gold's only gold's up $19 in a day. How exciting! You can hear the dismay in my voice as I happen to be in a short gold position. So go down. And for those of you guys that are long gold, I am so sorry. But go down. Anyway, with that, I'm going to jump to another caller here. It's a call-in show, and I'd like to get to as many callers as we possibly can. So I've got, I think it's Hassan in Phoenix. Are you there with us?
Yes, Don.
Yeah, how you doing?
I'm fine. Thank you. I really enjoy listening to your show. There's a lot of information in there. My question today is about the future contracts. I noticed that they move the futures before the market open, and then we see the actual, like S&P, for example, moves to reflect the moves in the future contracts.
Correct.
How is that done? Because in order to move S&P, you have to move the individual stocks. It's not like a portfolio. You move everything together.
All right.
And, sometimes you see S&P going up 1%, but it's only moving because Exxon or GE moved up. So, I mean, what is the relationship exactly?
So I'll explain exactly how this is done. It's interesting because a lot of people don't really understand how this works. Let's say that in the morning, before the market opens, let's say the futures were up 30. Does that make sense? So literally the futures are up 30. So what does that mean for the S&P 500? Well, the S&P 500 is going to open up significantly. Does that make sense? I mean, you understand that. So how then do the individual components of the S&P 500 move, all right, with the ultimate index product? And the question is, is a little different than a couple of years ago. All of this is done now through what's called statistical arbitrage. And what that basically means is there are servers all over the world. And what the servers do is they are tied, for instance, definitively to the S&P 500 futures. And these servers fire buy and sell orders into every component of the S&P 500. So they're actually firing buy and sell orders into the physical stocks that comprise the S&P 500 to keep each individual stock in relative tandem movement with the underlying primary index product. So when you saw like 10 years ago, you'd see the S&P 500 move, okay? When you saw the S&P 500 move 10, 15 years ago, only about 70% of the stocks would move in tandem with the S&P 500. Today, it's in the 90th percentile, meaning if the S&P 500 moves, okay, the stocks in the 90th percentile move in tandem with the primary underlying index product. And that's basically, it's done so all via server farms. And again, it's a form of statistical arbitrage. Some of the flash traders jump on this thing as well. But it's, it's all algorithms today. That's kind of the name of the game.
Okay. So they actually use the weight of the individual stock to decide how much it should move?
That's exactly it. So it's the exact same model that's utilized in the S&P 500. It depends on weighting, the size of the company, the market cap of the company versus the S&P 500, and it's literally a calculation.
Who actually does that?
I'm sorry?
Who actually does that? Who decides that, those stocks are going to be, they will actually, you actually need to have buyers and sellers to move the stock.
Yeah, well, no, it's a computer. So the computer is the buyers and sellers. So when you look at the buyer-seller, who could do this? Well, Goldman Sachs, any major derivative firm. There's 1,000 banks out there. There used to be 1,000 banks. Now there's only 2 banks. But anyway, there's there's hundreds of derivative firms out there that are all doing the statistical arbitrage. There's hedge funds doing this, like Citadel. Citadel's a hedge fund, but they're also a massive market-making firm. They're big in the statistical arbitrage world. You get firms like Susquehanna, and I can go on and on and on for like a half an hour. All of them in some way, shape, or form, they're buyers and sellers of these underlyings, not necessarily because they're bullish or bearish. That's you. That's a client, in the end. You might be bullish or bearish in an underlying. Ultimately, a lot of these firms, all they're trying to do is fire buy and sell orders and capture fractions of a penny between what the futures are doing and what the physical underlying stocks are doing. And they capture these fractions of a penny, and they do it tens of millions of times in a day. And, hey, that's their living. That's kind of the name of the game for a lot of these derivative firms. Yeah, and you have to look at this. Is this a bad thing for customers? No, it's a good thing. It creates liquidity. Massive liquidity out there. I mean, when you look at the spiders, and the spiders today, for instance, we're halfway through the trading day, and the spiders have traded 143 million shares. Hey, this is a relatively slow day. 143 million shares. Who trading all those shares? Well, statistical arbitrageurs are really trading these shares. It's computers that are firing these orders. I mean, there's all kinds of algorithms designed to keep, again, these stocks in line with what the S&P 500 is doing. And that's the business as it exists today.
Okay, so it's not actually someone looking at the fundamentals and deciding this stock GE should go up 2% today.
Nope.
It's all a statistical game they are playing behind the scenes.
Yeah, I mean, markets today are so efficient; they move literally at the speed of light. It's again, that's what it's about today. Is ultimately, who's got the fastest servers out there, and that's what they're really, entailing. Is again, it's a different business though than you guys are in. When you're in a trade, you're like, hey, I want to make a couple of bucks in this trade. I'm either bullish, bearish. Some of you guys do some neutral trades, in some of the option plays in terms of iron condors. But you look at a firm today like Goldman Sachs, and they're out there picking up, fractions of a penny in front of the bulldozer. And it's a different business, but it takes, hundreds of millions and even billions of dollars to get into, that type of trading realm. And it's not necessarily a good business right now because the bid-offer spreads have become so tight and competitive. Nature of this business has driven to the point where those spreads, you can't make any money on them. I mean, I'm looking at the spiders right now, and the markets are 1724 by 1725, and they'll fill you at literally a thousandth of a penny in between. It's a good thing. Good thing for you guys.
Okay. Thank you very much.
All right, thanks for giving this call. So, there's been some interesting callers today. We have everybody from Canadian gentlemen that called in about general ThinkorSwim technology. And by the way, that's always fair game for these for the option hour here. If you guys ever want to call me and ask us something about like a ThinkorSwim question, I'm your man to answer it. I mean, hey, it's not too exciting for everybody to listen, but if you've got a question about technology, 50 other people probably have the question as well. So we can always talk about technology. We can talk about trading technology in general in the marketplace. That last caller was kind of asking, hey, when the S&P 500 futures move, how come all the other stocks move? And it's because they move in tandem. I mean, there's servers now, and there's algorithms that literally drive, all 500 stocks simultaneously. When you see these futures move, these futures now drive order flow for the rest of the marketplace. So if the futures have a big move up or down, expect all the stocks in the component, of that futures product to be moving in tandem with that. So if you saw the futures right now are up 350, if all of a sudden these futures were up 20, okay, you'd see obviously drastic moves in every underlying pretty much on the board here today. So with that, and that's the kind of relationships that I talk about a lot. I talk about, for instance, S&P 500 futures are up 3, and then I'll take a look over, for instance, the VIX. The VIX is now down 55 cents in the day. So that's a common theme. You see a relationship when the market's up, volatility is inherently down. Then I'll look at, bond markets. Bond markets are definitely down on the day. So with bond markets kind of down on the day, typically when you see bond markets down, you see markets rallying. And this is not anything of a rally right now. With the S&P futures up 2 and 2.5, it's like a sleeper. So with that, a couple things I wanted to kind of wrap up with here, and I'm also reading some of the questions in the room over here. But by the way, the talk of the day here in the room looks like it's football. Yay! By the way, thank you for whoever posted the anti-Dallas propaganda there in the chat room. I appreciate that. I am also an anti-Dallas fan out there. If you're from Texas, sorry about that. Forget it. Anyway, with that, a couple of trades we've talked about recently is getting along, for instance, like things like TBT. Getting along TBT means you short bonds. I'm still persisting through these trades in the TBT. We've got TBT up 44 cents today. Not exactly a huge rally there, but we could use TBT up about $8 in a day. I'd be happy with about an $8 up move in TBT. But ultimately, I'm sitting definitely short some out of the money premium here in TBT. Also got a short position in gold, and I'm short out of the money call spreads all scattered all throughout gold over there. Something to keep your eye on as well. Oil's actually back up almost to $90 a barrel, so it's something also that I haven't talked about much recently, but as I start to see oil rally more and more, not uncommon. When markets have rebounded a considerable amount here already, you're seeing oil rebound, but oil's actually kind of been on its own tear, and oil's actually diverging from the S&P 500 quite a bit. Oil was trading in tandem with the S&P 500 literally week after week, and you're seeing oil now trading up with the S&Ps kind of flat. So we're seeing a lot of divergence between, for instance, the pair strategies between S&Ps, bonds, oil, gold, VIX. It's kind of a free-for-all today, all right? So markets kind of meandering. It's a little bit of free-for-all here. Markets, again, are a little bit tired. I would expect to see a rally towards the later half of the day here. It's an expiration week. A lot of expiration weeks, we do grind kind of the upside. It's, again, not unusual whatsoever. Now that I said that, though, I'm saying that market's probably going to grind to the upside here later today. I have probably screwed each and every one of us that is bullish here today. But as always, join me for the options hour. It's 12 noon Eastern Standard Time every Tuesday. And next week we're going to have a guest presenter come on for the options hour. And I'll see who I can con into doing this for an hour. I happen to be tied up at another function I'm going to be speaking at next week. So we're going to have a guest presenter, and I think I'm going to bring in J.J. Kinahan, who is again kind of one of the guys that helped create the show called Options Action on CNBC. He's a CNBC presenter all the time. So definitely want to stay tuned for next week and give him a call on there. Anyway, on behalf of ThinkorSwim from TD Ameritrade, everybody over at TFNN, thank you guys very much for helping out today. And as always, support these guys. They're fantastic. Good show. I appreciate you guys listening to the Options Hour today. Again, my name is Don Kaufman. Join me every Tuesday, 12 noon Eastern Standard Time for the Options Hour. Thanks a lot, everybody, and have a great day. Bye-bye.